economic downturn has hit the energy sector hard, with the cost of oil plummeting from the highs of last year. Compounding falling prices are rising costs, all meaning lower profits. Visiting Australia this week for the Local Industries National Conference was KPMG's Chairman of Energy and Natural Resources, Michiel Soeting. He spoke to Aaron Young about the impact of the GFC on oil companies.
Well, in a very significant way, obviously. Oil prices have been rising steadily through the last decade, actually. When they fall off a cliff, the impact was such that if you look at the cost structure of the oil companies, which has risen in the same proportionate manner, the cost structure is left hanging. So hence enormous cost pressure for the industry.
And just on that, I was going to ask you about costs. We're seeing profits down for the oil companies, yet it's also hard to contain costs right now.
Well, I think what you saw in the industry is that specifically in offshore subsea engineering work, there was a shortage of skilled work, commodity prices rising. So overall, we've seen a tremendous increase in prices. It's to some extent, I don't think it's about a lack of cost containment, but maybe a lack of focus to some extent on cost optimization.
And so as a result of prices coming down and costs going up, what sort of cost-cutting strategies have we seen from the oil companies?
Well, we've seen immediate response on putting pressure on suppliers, with suppliers being asked to have cost reductions in excess of 20%. And that's actually an immediate measure we've seen across the whole industry the last 6 months.
And it's not as if costs are going to get any cheaper in the future, given that oil is a finite resource, there's only so much, and companies are going to have to dig deeper and go further out to find it.
I think that's right. I think the era of cheap oil is over, and I think the tendency is that all companies need to look far further and in more difficult circumstances. I think the offshore gas fields in Australia are an example of that, because you need an additional LNG infrastructure to actually monetize those gas fields. We see it elsewhere in the world as well, in the oil sands Canada or the Sakhalin field in Russia. Tremendous costs are needed to develop those fields, and I think the general trend is that the capital expenditure for the industry has been increasing over the years, and hence the importance of cost containment in order to make it economic viable.
And so what role does OPEC play in all this? Will that organisation be key in our economic recovery?
Well, OPEC clearly has its own interests. They want to maintain a steady price level in their view, which would reward their effort for the energy supply in the world, but also they have a keen interest in reviving the global economy, and they realize in the current environment, if you would have high crude price, that would potentially damage the recovery of the economy.
Michiel, you're an independent witness. How does Australia stack up compared to the rest of the world?
I must say Australia is a country with tremendous potential and resources. I think you're on the brink of unlocking some of those resources, like the offshore gas fields. If you look at from a global perspective in the gas market, we see existing traditional fields like the North Sea depleting, and the world is looking for new territories. Australia has always been considered as a country with those resources. However, you had the issue with transportation. I think where the industry is focusing currently in Australia on LNG solutions would provide great opportunities for Australia.
Here in Australia, we've seen a lot of consolidation, particularly in the coal seam gas market. Are we likely to continue seeing that?
You mean the consolidation linked to a certain specific resource?
That's correct, yeah.
I think where the oil industry already has a history of linking up on large projects, I think it's an industry where we see a lot of joint ventures. And why? That's actually because even the largest company realized that some of the products may be too big for them, or they don't want to carry the full risks. I think in general with unconventionals like coal seam beds and coal seam gas particular, that if you look at the investments and also the location of these assets without any infrastructure, I think that that could potentially for one oil company it could be considered as too large a project, and hence I think what you see as a tendency, but that has been already a tendency for years in the industry, that all companies will group together and see if they jointly can make that investment.
In Australia at the moment, we're discussing an emissions trading scheme. We're seeing accusations that some of the big companies have been lobbying the government with alarmist remarks about what it will do, yet at the same time suggesting and telling shareholders that everything's going to be okay. What has happened to oil companies and resource companies in other parts of the world after countries there have introduced an ETS?
Well, in general, clearly there is a cost element. We have to see similar discussions actually currently in the United States with cap and trade systems, where clearly it's recognized that those type of trade schemes will have a cost element for the industry. So the industry as a whole, I think, is looking actually for the best ways to tackle the climate change and climate change issues. In this country, the industry thinks that LNG could be an example of that, but there's, I think, the jury's still out whether carbon cap trading schemes like the one you have here in Australia or the one currently planned for the US will, in the long term, reach its objectives.